This video aims to give the best explanation and understanding of inflation through a Bitcoin perspective. First, we have to define inflation. There are two types of inflation: monetary inflation and price inflation. Monetary inflation is an increase in the currency units, most often done through the actions of central banks and the banking system as a whole. This is also what is called currency or monetary debasement. As an example, the total sum of US dollars increases around 7% per year. Price inflation is when the prices of goods and services are rising. Prices are determined by supply and demand. When demand is high compared to supply, prices rise; vice versa, when demand is low compared to supply, prices fall. In the short term, prices can fluctuate due to many different factors, like supply chain disruptions and other phenomena that affects the supply or demand. Over a longer time horizon, prices are not rising as a result of changing factors of the products and services themselves. No, prices are in fact rising as a result of monetary inflation. Or in other words, because of the continuous increase in currency units, leading to more and more money chasing a certain amount of goods and services. Since prices are rising over the long run when money is debased, it means that the currency is losing purchasing power at the rate of debasement. If you increase the supply of currency units, the total purchasing power of the whole currency have to be shared amongst more currency units. As an example, if the US dollar has an average annually debasement rate of 7%, the currency should lose 7% of its purchasing power per year. Or in other words, prices of goods and services should on average rise at 7% per year. But why are the average annual inflation rate of goods and services in the US not measured at 7%, but only 2 to 3% per year? This is because the free market is deflationary in its nature. Businesses and companies are competing at offering the best products and services at the lowest price. Through technological development and adoption, they are able to make efficiency gains by getting more output through the same or less input. This process creates abundance of goods and services. In sectors like technology, we even see falling prices over time when measured in dollars. This is because the efficiency gains and increase in abundance is growing at a faster rate than the monetary inflation rate. In other words, tech products and services are getting debased at a faster rate than the currency. Just look at the amount of memory you can buy today for $1 compared to 20 years ago. So the reason why we don't see 7% inflation of all prices is because we assume inflation would be 0%, if the monetary inflation is also 0%. But because of the natural deflationary tendencies of the free market, the inflation rate would actually be negative. In other words, this is where the 7% monetary inflation is hiding. Even though the inflation rate is only 2 to 3% per year, you are still losing 7% of your purchasing power through debasement. Since people want to keep their purchasing power, a lot of them invest in scarce assets like the S&P 500, which is an index that follows the general stock market. The long-term average return rate for the S&P 500 is 7 to 8%. In other words, the S&P 500's nominal return rate is the same as the monetary inflation rate. The return is an illusion because we measure the return in a currency that is getting debased. So the S&P 500 essentially just preserves the purchasing power that you could have kept if the currency was not debased. Most asset classes and portfolios can't even keep up with the monetary inflation rate. If you invest in these, you're essentially not preserving your purchasing power, but just losing it slower than if you had held it in a fiat currency. The fiat monetary system is your enemy. The system is essentially forcing you to take a risk and invest in assets, if you want to preserve your wealth and purchasing power. Most people don't even preserve their wealth and purchasing power, but only manage to lose their purchasing power at a slower rate than if they stored their wealth in their local fiat currency. But it gets even worse. Since most assets have a positive nominal return measured in fiat, you have to pay taxes on the nominal return, even though you might not have a real return. In other words, if you manage to lose your wealth at a slower rate than if you stored it in fiat, you have to pay taxes. This unethical practice makes it even harder for people to save and preserve their hard-earned wealth. This is why we are in a desperate need for a new global monetary system that is ethical and fair. A network where everyone is playing by the same rules, and no one has the power to change the rules. A network where the money has a limited supply rate, so people have the ability to save and preserve their purchasing power. A network where the money can't be censored or confiscated. A network that is unstoppable.